I think more along my skill set would be watching Warren Buffett uh, allocating capital over the years and trying to learn from what he ended up liking. One of the best things I ever learned from was when he bought Coca-Cola and analyzing how he could pay at that time what I thought was such an astronomical price for a fairly mundane business. It had great franchise, obviously. It was growing reasonably, but still, based on just my cheap gene of buying things cheap and trying to learn from someone who wanted to buy good and cheap, how much could you pay? And so we ended up, Rob and I ended up analyzing when we took a look at, we like to look at spin-offs and different things. We took a look at Moody's, which is, the rating agency, which was trading at 20 times earnings at the time we were looking at it. And that's not, back when we were looking at it 20 years ago, was not a value investing kind of multiple. The value investing kind of multiple at that time was 6, 7, 8 times. And this was trading at 20 times. But we loved the business. And so one of the exercises we did is said, okay, let's compare it to when Buffett bought Coca-Cola and compare the metrics of these businesses and how they deploy capital, what kind of returns do they get, how fast does it grow, all those things, and see whether it's as good. Turned out it wasn't as good. It was, if you said that Buffett bought Coke at $10 a share, it worked out that we were paying $13 for Moody's. But of course, Coke went to 30 or 40. And so, within 5 years. And so paying 13 for something that goes to 30 or 40 would also have been pretty good. So even though we compared it and said, hey, Buffett got a better deal, even adjusting for the type of business it is, it was really great to have that. So just looking how he allocated, his allocation of capital is like most akin to ours as an investor. He runs his business like it's a portfolio of companies. A stock is not a piece of paper that bounces around that you put fancy ratios on. They're actually ownership shares of businesses that you value. And at the end of the day, our only home base or true north is that, hey, this is an ownership share of a business. Can I value this business as if I'm owning the whole company like a private equity firm? What's it worth? What am I paying? Is management going to be a good steward till we get there? You ask those kind of questions. But that's how we look at it. And Buffett's just turned that into actually putting together a conglomerate of a portfolio of businesses like that. So I think he's the one I've learned the most from. But Bezos, I think, taking us into looking at the way companies deploy capital. Like if you look at Costco, for instance, they very straightforward. We don't make money on our business. We make money from our memberships. And, it's you talk to Jim Collins, so it's a flywheel where if you can sell people products at cost, it's very hard for people who are trying to make a profit to beat you. But if you can make all your money on the memberships, just selling more and more memberships for the ability to buy at cost, very simple model, not so hard to understand. And the more members you get, the better you can do, the more business you can do, and the flywheel turns. And so there are few and far between, but there are models like that. Just learning from watching the best do it, as you're suggesting. I don't want to name 5, but those are 3 models that have certainly resonated with me.